Welcome to our deep dive into the stock market. We've got some really cool resources from Dow Jones all about how this whole thing works. It's perfect for anyone looking to go a bit deeper, beyond those investing basics.
Yeah, we'll be breaking down all that jargon, those key players you always hear about, like the Dow, the S&P 500, and even tackling those mysterious bull and bear markets you might have heard about.
Definitely going to be some aha moments today. We're going to uncover how companies go public, what really makes stock prices move, and even how to start building your own portfolio, no finance degree required.
Absolutely.
So to kick things off, let's go back to the very beginning. What even sparked the creation of the stock market?
Well, the stock market's origin story, it's actually pretty simple. Entrepreneurs needed money, and investors were willing to take a risk.
Well,
Imagine a time before computers, right? All these deals happening face to face.
wow. Yeah.
Totally different from today's, super fast, high-tech trading world.
It's amazing how much has changed. But before we jump into today's market, let's talk about the different types of companies out there. Private versus public.
Yeah, that can be confusing.
Hmm.
You might be surprised, actually. Some massive companies, huge brands, are actually privately owned.
I think a lot of people assume, if a company's big and well-known, it must be on the stock market.
Right, that's a common misconception. Private companies, they could be anything from small businesses to huge multinational corporations. The key thing is they don't offer shares to the public.
Got it. So when a company does decide to go public, it's kind of like they're throwing a massive party, right? An IPO party.
Yeah, I like that. An IPO, or initial public offering. That's when a private company first makes its shares available to the public, on the stock market. It's a big moment, and there are a few reasons why they do it.
I'd imagine the main reason is to raise capital, right? Like a huge infusion of cash to help them grow and expand.
Exactly. Companies use that capital for all sorts of things: hiring, research and development, building new facilities, or even buying other businesses. Going public really opens up a whole new world of possibilities.
Sounds exciting, but probably pretty complex too.
Oh, for sure. It's complicated, definitely some regulatory hoops to jump through. But for businesses with big ambitions, going public can be, transformative.
So let's talk about stocks themselves. We hear about buying and selling stocks all the time, but what is a stock, really?
Basically, a stock is a tiny piece of ownership in a company. When you buy a share of stock, you become a part owner, even if it's just a tiny fraction.
So it's more than just a ticker symbol on a screen.
Definitely. It represents an actual stake in the company's future. And what's really interesting is how the journey of a stock unfolds. Let's say a company goes public, issues stock. What happens next?
That's what I'm curious about. Does it just magically appear on the market?
Not magic, but pretty intricate. The initial price is set before the IPO, then the shares start trading on what's called the secondary stock market. Places like the New York Stock Exchange or the NASDAQ.
So that's when, anyone with a brokerage account can buy or sell those shares.
Exactly. It's like this huge marketplace where buyers and sellers are constantly trading shares of these public companies.
This is where it gets really interesting for me. What actually makes stock prices go up or down? Is there some secret formula?
If only there was. No secret formula. But it can feel pretty unpredictable. Lots of factors play a role. A company's sales and earnings, its profit margin, even the overall health of the economy can all affect things.
So generally speaking, if a company is doing well, its stock price is likely to go up.
Yeah, that's the general trend. Investors, they're drawn to companies showing gross profitability. Like if a company announces great earnings or unveils some amazing new product, demand for the stock goes up, driving the price higher.
Makes sense. But it's not always smooth sailing, right? Prices can fall too.
Oh, absolutely. If a company hits some bumps, like declining sales, bad news, investors might start selling their shares, pushing the price down.
It's a bit of a roller coaster ride, it seems.
That's a great way to put it. The stock market can be volatile, with prices constantly fluctuating based on all these different factors.
Makes sense. But I think for a lot of people, the stock market feels kind of like this exclusive club for financial experts. How can everyday folks actually get involved?
Well, that's where the idea of a portfolio comes in.
A portfolio, so like our own personal stock market team.
Exactly. It's simply a collection of all the stocks you own. Building a portfolio is kind of like putting together a dream team, of stocks that fit your goals, your belief in those companies.
But with thousands of companies out there, how do you even begin to pick the right players for your team?
That's where portfolio management gets really interesting. It's all about balancing risk and reward.
Risk and reward, huh? That sounds kind of intense.
It can be. Different stocks have different levels of risk. Some are more stable, predictable, while others are more volatile. They can swing up or down dramatically.
So finding the right balance is key.
Exactly. A big part of it is diversification. Spreading your money across different types of stocks, different industries, to reduce the overall risk.
So if one stock takes a hit, it doesn't wipe out your whole portfolio.
Right. Diversification is like a buffer. Protects you from huge losses, helps you build a more stable strategy.
Okay, I'm starting to see the bigger picture. But what about those stock market tickers we always see on the news, like the Dow Jones, S&P 500? What's the deal with those?
Those are stock market indexes. Think of them like report cards for the overall market. They track how a specific group of stocks is doing, giving investors a snapshot of, well, how the market's performing as a whole.
So they're like a benchmark, something to measure against.
You got it. And there are a few key indexes that pretty much everyone watches, the big three. The Dow, the S&P 500, and the NASDAQ.
Yeah, and they each kind of tell a different story about how the market's doing. Let's start with the Dow Jones Industrial Average, often just called the DJIA, or even just the Dow. It's made up of 30 big, well-established U.S. companies, like think American Express, Home Depot, Coca-Cola, Nike, those kinds of names.
So it's like a roster of, blue chip all-stars, the biggest names in corporate America?
Exactly. The Dow, it's seen as a really good indicator of how the U.S. economy as a whole is doing. When you hear on the news the Dow is up and the Dow is down, that's usually what they're talking about.
Makes sense. What about the S&P 500? How's that different?
So the S&P 500, or Standard & Poor's 500, it takes a broader view. It tracks 500 of the largest publicly traded companies in the U.S. That includes companies like Microsoft, Google, Disney, Netflix. Since it covers more companies, a lot of investors see it as a more, complete picture of the market.
So it gives you a wider lens, so to speak. Exactly. And then there's the NASDAQ, which seems to have this thing for tech, right?
Yeah, it definitely feels tied to that world, all the innovation and technology.
It is. The NASDAQ Composite Index, it tracks all the stocks traded on the NASDAQ Stock Exchange. And that exchange, it's known for listing a ton of tech companies, those growth-focused businesses.
So we're talking companies like Amazon, Apple, Meta, formerly Facebook, and Tesla.
You got it. Those are some of the heavy hitters on the NASDAQ.
Yeah.
And it's worth noting, the NASDAQ, it tends to be more volatile compared to, say, the Dow or the S&P 500.
Yeah.
Meaning its value can jump up or down, pretty dramatically in a single day.
It's like the NASDAQ is the more adventurous roller coaster. The Dow and S&P 500, those are more like the steady rides.
Yeah, good analogy.
Yeah.
So we've covered a lot. Companies going public, what stocks actually are, how to start building a portfolio, all these indexes. There's one more thing I'd love to talk about, bull and bear markets. Are these just, Wall Street slang, or there's something more to them?
I've always wondered about that. They sound more like something you'd find at the zoo.
Right.
Yeah.
They might sound like animals, but they're actually really important for understanding market trends. Think of the stock market like a roller coaster, right? Ups and downs, thrills and chills. A bull market? That's a period when prices are going up. Usually lasts for months, sometimes even years.
It's like that saying, a rising tide lifts all boats.
Yeah, that's a good way to think about it. In a bull market, investors are optimistic, everyone's buying, so prices just keep going up. It's like everyone wants to be part of that momentum.
And then the opposite, a bear market.
Right. A bear market, that's when prices are falling. And just like a bull market, it can last for a while. Investor sentiment, it gets kind of gloomy. Everyone's selling, so prices keep dropping.
I can see why they use the image of a bear for that one.
It fits.
Yeah.
But it's important to remember, bear markets, even though they can be scary, they're actually normal. Just like economies go up and down, the stock market does too. It has its cycles.
That makes sense. It's like the ebb and flow of the financial tides. But how can investors tell if they're in a bull market or a bear market? Any signs to look for?
Well, you can't predict the market perfectly, but there are some clues. One thing is how those major indexes are doing. Like if the Dow, the S&P 500, and the NASDAQ, if they're all going up, that's usually a pretty good sign you're in a bull market.
Okay, but what about some less obvious signs? Things beyond just the indexes.
That's a good point. Index performance is important, but so is how investors are feeling. The news, economic data, even what's trending on social media, that can all affect how people feel about the market, which in turn affects what they do with their money.
So it's not just the numbers, it's also the overall mood, the vibe of the market.
Exactly. Think of the stock market as this giant auction, right? Where the price of everything in the stocks is determined by what people are willing to pay. If everyone's happy, eager to buy, prices go up. But if there's fear, uncertainty, well, more people might be selling and prices go down.
Okay, that makes sense. So how do bull and bear markets change how investors act?
Well, in a bull market, investors might be more likely to, jump in, hoping to ride that wave of rising prices. But it's important to remember, even in a bull market, there's always risk. On the other hand, during a bear market, some investors might hold on to their investments, hoping things will turn around, while others might make changes, to try to avoid losing too much money.
So understanding these bull and bear market things, it's all part of making smart decisions, right?
Absolutely. It helps you navigate the ups and downs and come up with a plan that works for you.
Wow, this is a lot to take in. It's amazing how complex it all is when you really start digging into it.
It is a complex system, for sure. But getting a handle on the basics, that can make you a much more informed investor.
So for someone who's just starting out, what are the most important things to remember?
Well, first of all, investing always has some risk. It's not a guaranteed way to get rich, and you could lose money.
That's a good point. It's important to be realistic, to understand that both gains and losses are possible.
Exactly. Another key thing is to do your research. Before investing in any company, take the time to learn about their business, their financials, what their future looks like.
So no blindly jumping on trends or hyped up stocks.
Right. Build a diversified portfolio, one that fits your goals and your risk tolerance.
Speaking of risk tolerance, how do you figure out how much risk you're comfortable with? Seems like a pretty important part of the whole thing.
It is, and it's very personal. Things like your age, how long you plan to invest, your overall financial situation, that all plays a role. For example, if you're younger and you have more time before you need the money, you might be more willing to take bigger risks, go for those higher potential returns.
So time is on your side.
It can be.
Yeah.
But if you're closer to retirement, you might be more cautious, looking for investments that are more stable, focused on protecting what you've already saved.
Sounds like it's all about finding the right balance.
Exactly. And remember, there are people who can help. Financial advisors, they can give you personalized advice, help you make a plan that works for you.
Like having a guide on your financial journey.
I like that. Okay, so we've talked about the basics, about bull and bear markets and how to diversify. Before we wrap up, what are some of the biggest mistakes new investors make?
Yeah, let's talk about those pitfalls. What should people watch out for?
One of the biggest ones is letting emotions take over. Fear and greed, those can really mess with your judgment, lead you to buy or sell at the worst possible time.
So that whole FOMO thing, fear of missing out, that's a real danger in the stock market.
Big time. You got to stay disciplined, stick to your plan, even when things get crazy.
Don't panic and sell everything when the market dips.
Exactly. Remember, investing is a long game. It's about riding out those ups and downs, keeping your eyes on those long-term goals. Another mistake is not diversifying enough.
So back to that, not putting all your eggs in one basket.
Yep. Sometimes investors get too focused on one stock or one industry, and that can really increase their risk.
Diversifying across different stocks, different industries, even different types of investments, that's the key.
Absolutely. Helps you spread that risk around, build a portfolio that can weather any storm. So we've talked about the don'ts. What about some do's? Any advice for someone just starting out?
Yeah, let's switch gears from pitfalls to pathways to success. What are some good principles to follow, strategies to keep in mind?
One of the best pieces of advice, honestly, is to start early. Time is your best friend when it comes to investing. This thing called compounding, it lets your investments grow exponentially over time. So the sooner you start, even with small amounts, the better.
So even if you're just beginning, those small, consistent investments, they really add up.
They do. Another tip, stay informed. The world of investing, it's always changing. Keep up with trends, learn about different strategies, and don't be afraid to ask questions. There's so much information out there. The more you know, the better your decisions will be.
So this deep dive, it's a good start, but it's really just the beginning.
Exactly. Keep learning, keep growing. There are great financial websites, books, podcasts, even advisors who can help you one-on-one.
And what about getting some actual experience? Any way to, practice without putting real money on the line?
That's a smart question.
Yeah.
A lot of brokerage platforms have these things called practice accounts or simulated trading accounts. You can learn how to buy and sell, track your pretend portfolio, and see how the market affects things, all without risking any real money.
So it's like a test draft before you actually hit the road.
Perfect analogy. It's a great way to gain confidence, get comfortable with everything before you actually start investing.
Sounds like a great way to, learn by doing, but in a safe space.
Yeah.
Well, I think we've covered a ton today, from the very beginning of the stock market to all the ins and outs of portfolios and those bull and bear markets.
It's been quite the journey, right?
It has, and hopefully our listeners feel like they can take that next step with all this knowledge and these new insights.
That's what we're hoping for. Investing is full of potential. And the more you know, the more confident you'll feel making those decisions, working towards your financial goals.
Well said. So on that note, we'll wrap up our deep dive into the stock market for today. Thanks for joining us, and until next time, happy investing. I feel like we've really, gone deep, unpacked so much about the stock market.
It has been a great deep dive. And remember, investing, it's not a one-time thing. You're always learning, always discovering something new.
Definitely. So for our listeners who, want to keep going, what resources would you recommend? Where should they look?
There's so much out there. Online, at libraries, tons of great stuff. Websites like Dow Jones, the Wall Street Journal, those are great for learning the basics, keeping up with the market, even researching specific companies.
And there are books, podcasts, all sorts of stuff geared towards beginners, right?
Oh, yeah, tons. So many resources that make investing, well, easy to understand no matter what your experience level is.
That's great to know. It's not as intimidating as it might seem then.
Not at all. And don't forget about those practice accounts we talked about. A lot of online brokers offer those.
Right. Those are awesome. Like a way to, test the waters without any risk.
Exactly. Get comfortable with buying and selling, see how your portfolio does, how the market affects things, all with pretend money. It's a great way to build up your confidence before you, dive into the real thing.
It's like a dress rehearsal for the main event.
I like that. And one last thought, just remember, investing, it's a marathon, not a sprint.
That's such a good reminder. Patience and consistency, those are key.
They are. Stay focused on your long-term goals, keep learning, make informed decisions, and you can really, navigate all those twists and turns and reach your financial goals.
Well said. So I think that's about it for our deep dive into the stock market. We've covered a lot, from the very basics to some more, advanced stuff. Hopefully our listeners feel ready to take that next step, start exploring this world on their own.
I hope so too. Investing, it's full of possibilities, and the more you learn, the more confident you'll be.
Couldn't agree more. Thanks for joining us, and until next time, happy investing.